A business owner's policy, a BOP, is the most commonly purchased insurance policy by small businesses in the United States, and is generally a strong foundation for a lot of operations. But most commonly purchased doesn't mean most commonly structured correctly. The three coverages inside a BOP policy work together, and when any one of them is set up wrong, the whole program can fail when you need it most. In 2026, that gap matters more than it used to, because commercial property pricing has actually started to ease industry-wide, which is good news, but it also means a lot of BOP policies written during the harder market of the last few years are carrying stale property values that were never revisited when rates softened. A policy that's cheaper isn't automatically a policy that's right-sized. Most small businesses face the same court risks every day. A customer is injured on your premises. A fire damages your location. Inventory is stolen. A storm shuts you down for 3 weeks. Any of these events creates two separate problems. First, the immediate cost of the loss itself. And second, the ongoing cost of not being able to operate. Rent, payroll, loan payments while you're closed. Property insurance covers the first problem. Business income coverage handles the second. And general liability covers the third-party claims that come from the first. A properly structured BOP policy addresses all three at once. The issue isn't whether you have one, it's whether what's inside actually matches your business. A business owner's policy bundles three foundational coverages into a single policy: general liability, commercial property, and business income coverage. It's designed specifically for small to medium-sized businesses, generally those with fewer than 100 employees and under $5 million in revenue, where those three core exposures exist, and a combined policy provides both coverage efficiency and cost savings compared to buying each separately. Here's why the business income component deserves particular attention, because according to FEMA, roughly 40% of businesses never reopen after a disaster, and another quarter of those that do reopen fail within a year. In most of those cases, the building gets rebuilt and the equipment gets replaced, but the income that was lost during the closure, the rent still came due, the payroll still had to be met, and the loan payments that didn't pause. Those costs continue whether the doors are open or not. Business income coverage is what bridges that gap, and is consistently the most undervalued and most underfunded component of the policies we review. Additionally, the Hartford's claim analysis has found that roughly 40% of small businesses experience a property or liability claim in the past 5 years, meaning those aren't remote scenarios. For most businesses, a BOP claim is a matter of when, not if. Here's what a standard BOP policy includes, and critically what it doesn't. General liability covers third-party bodily injury, property damage, and advertising injury claims arising from your business's operations. A customer slips and falls. Your employee damages a client's property. A competitor alleges your ad was defamatory. Commercial property covers your building, equipment, inventory, and business personal property against fire, theft, vandalism, and certain weather events. It can be written on a replacement cost basis, meaning full cost to replace, or actual cash value, which factors in depreciation. The difference is sufficient and often not disclosed at the time of purchase. Business income replaces your lost revenue and covers your continuing operating expenses: rent, payroll, utilities during the period your business can't operate due to a covered property loss. Most policies cover up to 12 months of lost income based on your prior financial records. Now, what a BOP does not cover, and this is where most businesses have unrecognizable gaps, is professional liability. If your work generates advice, deliverables, or specialized expertise, workers' compensation, required in most states for employees and never included in the BOP policy, commercial auto for any vehicle used for business purposes, cyber liability, increasingly essential but not standard unless specifically endorsed, employment practices liability, since discrimination and wrongful termination claims are excluded, and flood and earthquakes, which standard BOP property coverages explicitly excludes. Separate policies or endorsements are required for both, and there are businesses that don't qualify for BOP at the time. Higher risk industries, larger operations, or businesses with complex liability exposures that need individually structured commercial package policies instead. Placing a business that should have a commercial package on the BOP or vice versa creates structural gaps that may not be visible until a claim is denied. A fire starts in the kitchen of a restaurant and damages the dining room. The commercial property component covers the physical repairs. The business income component covers the revenue lost during the 6 weeks of closure, plus the ongoing rent and payroll that didn't stop. A customer slips on the wet floor near the entrance of a retail store, fractures a wrist, and files a lawsuit. The general liability component responds, covering medical costs and legal defense. A storm damages the roof of an office building, and the water ruins the server room and all the equipment inside. Commercial property covers the replacement cost of the equipment. Business income covers the period when the business can't operate during restoration, if the limits are set correctly. A retail shop is burglarized overnight. Inventory worth $40,000 is stolen. The commercial property component responds, if the business income value was accurately reported when the policy was written. A business renews its BOP policy at a lower premium because rates softened industry-wide in 2026. The owner treats it as a win and moves on. When nobody checked, the business had added a second storage unit and roughly $60,000 in new equipment over the past year, and none of it was reflected in the renewal values. The lower premium didn't reflect a better risk, it reflected a policy that was already behind. The last scenario is where the most common BOP policy failures happens today. Not because the coverage wasn't there, but because the values were never re-updated as the market shifted. We see business owner policies placed with problems constantly, often on businesses that had the same policy for years without review. Property values are set too low, either at original purchase price rather than replacement, or never updated as the business grew. When a loss occurs, the payout reflects what was reported, not what was lost. Business income limits not tied to actual financials, the limit should reflect the realistic revenue and fixed expenses for the period it would take to restore operations. Generic limits set without reviewing the business's financial records routinely fall short. Wrong business classifications. BOP policies use classifications to determine eligibility and pricing. And an incorrect classification can result in coverage gaps for the work the business actually does, or in a policy that shouldn't have been written on a BOP policy at all. Exclusions not reviewed at point of sale are flood, earthquake, cyber, and professional liability exclusions since they're standard. For businesses in flood zones, earthquake zones, or any businesses that handle clients' data, those exclusions are material gaps that need to be addressed separately. Endorsements not added. Cyber liability, equipment breakdown, hire than non-owned auto, and employment practices can often be added to a BOP policy. Whether that should be is business specific, and they're almost never discussed unless someone asks us. And a renewal treated as a rate check instead of a program review, a premium going down or staying flat says nothing about whether the underlying values and limits still match the business. And in the softened property market, that match is easy to miss. At Corey Washington & Company, we don't treat a business owner policy as a default or a checkbox. We review how your business actually operates, what property you own, and at what value, what your revenue and fixed costs look like, and what exposures your business carries that a standard BOP policy may not cover. Then we decide whether a BOP policy is the right structure, and if it is, we build it correctly. Accurate property values, business income limits tied to your actual financials, endorsement for the exposures that matter, and clarity on what isn't covered and what needs to be addressed separately. Because a BOP policy that's structured correctly is one of the most efficient forms of a small business protection available, and one that isn't is coverage that looks complete until you need it. The goal is simple coverage without sacrificing real protection. If you have a BOP policy and you're not sure whether it was built for your business or just placed quickly to satisfy a requirement, that's exactly the kind of review we do. Link is in the bio. Let's build your program the right way.